If you've ever stared at your cash and thought, should I put it all in now, or should I spread it out so I don't mess this up? You're not alone. This is one of the most common points where smart people freeze. Not because they're careless, but because the decision feels loaded. If you invest a lump sum and the market drops next week, you'll feel like you did it wrong. If you drip money in slowly and the market rises, you'll feel like you missed your chance. And the frustrating part is that most explanations online don't actually calm that feeling down. They throw statistics at you, or they argue like there's one correct answer and you're supposed to just pick a side. In this video, I'm going to make this finally make sense in a calm, practical way. Not by predicting what markets will do, not by promising outcomes, but by showing you what dollar-cost averaging and lump sum investing really are. What they're protecting you from, what they cost you, and how to choose between them without second-guessing yourself every time you open your account. Because the goal here isn't to be perfect. The goal is to build a system you can live with, one that keeps you investing through real life, real emotions, and real uncertainty. And in a moment, I'll show you a simple way to decide that feels clear instead of stressful. Quick framing before we go deeper. This isn't financial advice. It's a simple, educational breakdown of how investing decisions like this actually work, explained clearly and calmly. Nothing here is about quick wins. It's about making decisions you can stick to without needing constant reassurance. Also, when people argue about this topic, they often argue as if the only thing that matters is maximizing the result in hindsight. But you don't invest in hindsight. You invest forward while you're human, with a nervous system, with a job, with bills, with memories of past mistakes, and with a brain that hates regret. So we're going to treat this like a real-world decision, not a math puzzle. Yes, we'll talk about the logic, we'll do a time-based illustration, we'll walk through what it looks like in real life. But we'll also talk about the invisible part, how each approach changes your behavior, your confidence, and your ability to keep going when the market doesn't cooperate. Because the biggest cost in investing usually isn't a single wrong move. It's stopping, it's stalling, it's constantly restarting. It's the mental friction that makes you delay for months while you wait for the right time. And in a moment, you'll see why this decision, lump sum versus dollar-cost averaging, is less about being brave or cautious, and more about choosing the style of risk you can actually tolerate without breaking your plan. Here's exactly how we're going to break this down, and I'm going to keep it structured so it stays easy to follow. First, we'll define what each approach actually is in plain English, what lump sum means, what dollar-cost averaging really means, and why people confuse the purpose of each. Second, we'll zoom out and build two simple mental models you can carry with you. Not formulas you need to memorize. Mental models, ways of thinking that help you decide calmly even when you're uncertain. This is where it starts to click because you stop asking which is better and you start asking what problem am I solving. Third, we'll make it feel real with scenarios. I'll walk through at least 3 realistic beginner situations. The bonus money situation, the monthly investing situation, and the I'm afraid to do it wrong situation. And we'll include a clear time-based illustration so you can see how this plays out over months, not minutes. Then, we'll translate everything into a simple, behavior-based decision process you can use without apps, without market predictions, without trying to outsmart anything. Just a calm way to choose, commit, and move on. And before we get to that decision process, there's one big misconception that causes most of the stress here. In a moment, we'll name it. Because once you see it clearly, the whole debate becomes much quieter. Let's start with the simplest definitions, because a lot of confusion disappears when the words become concrete. A lump sum investment means you have a pile of money, maybe $5,000, $20,000, $50,000, whatever, and you invest it all at once in one decision, rather than spreading it out over time. Dollar-cost averaging, often shortened to DCA, means you invest smaller amounts over time. Instead of one big deposit, you spread it across weeks or months. For example, you might invest $500 a month for 10 months rather than $5,000 today. That's it. Those are the mechanics. Now here's the part most people miss. These two approaches are not just two ways of moving money. They are two ways of managing uncertainty, both in markets and in your own head. Because the stress you feel here usually isn't about the math. It's about the fear of regret. If you invest a lump sum and the price drops soon after, your brain labels that as a mistake, even if it wasn't one. It feels like you bought at the wrong time. You imagine an alternate version of you who waited a bit longer and got a better entry. And that imagined version haunts the real version. On the other hand, if you dollar cost average and prices rise right away, your brain labels that as a mistake too. Even though nothing bad happened, it feels like you should have invested sooner. You feel like you diluted your own progress by being cautious. So both strategies can trigger regret, just in different directions. Here's the first key insight. The market is not grading you on your entry point, but your emotions might. And the biggest risk for a beginner is not choosing the mathematically best approach. The biggest risk is choosing an approach that you abandon. So the real question becomes, which approach makes it easier for you to stay invested? Now let's step one layer deeper. And this is where it starts to get clean. Why does lump sum often get described as better? Because markets have an upward drift over long periods. That doesn't mean they go up smoothly. It means the general long-term direction has historically been up more often than down. So if you invest earlier, you have more time in the market, and more of your money gets that long exposure. That's the logic behind just invest it. But that statement hides something important. It assumes your ability to tolerate short-term drops. It assumes you won't panic, second-guess, or bail out. It assumes you won't invest the lump sum and then spend the next 3 months checking it daily, feeling sick every time it dips. And for some people, that assumption is false. Not because they're weak, but because they're new. Now, why does dollar cost averaging get described as safer? Because it spreads out the moment of entry. If prices drop after you start, you're still buying at lower prices later. If prices rise, you at least participated early. It reduces the emotional intensity of any single day. But again, that statement hides something. It can be safer emotionally, but not always safer in every sense. Because spreading money out can also mean staying partially in cash for longer, which has its own risks, like inflation slowly eroding purchasing power, or the simple opportunity cost of not being invested. So both approaches are trade-offs. Now let's make it extremely clear with an everyday comparison. Imagine you're getting into the ocean. A lump sum approach is like jumping in all at once. It's immediate. You're in, you're done. If the water is cold, you feel it intensely, but you also adapt quickly because you're not prolonging the experience. Dollar cost averaging is like walking in slowly. You keep control, you acclimate in steps. It reduces the shock, but it also means you spend more time in that awkward zone where you're half in, half out, constantly adjusting. Neither is morally better. They just feel different. And different people handle those feelings differently. Now, before we go into models and scenarios, I want to show you the big misconception that causes most of the anxiety. The misconception is this. People think this is a question about timing the market. It isn't, at least not in the way most people mean. Timing the market usually means trying to predict what will happen next, so you can buy at a low point and avoid a drop. That's not what we're doing. Lump sum versus DCA is not asking, can I predict the next month? It's asking, how do I want to distribute my exposure to uncertainty over time? That is a very different question. Here's a simple way to see it. With a lump sum, you accept uncertainty now. You take the full unknown immediately in exchange for being fully invested sooner. With DCA, you spread uncertainty across many smaller decisions. You reduce the emotional impact of any single moment in exchange for delaying full exposure. So it's not prediction, it's packaging. You're choosing how to package the same uncertainty. And that's why you can be a perfectly rational long-term investor and still choose DCA sometimes. Not because you're trying to outsmart the market, but because you're trying to outsmart your own tendency to freeze. Now let's build the first mental model, because this is where the decision stops feeling like a debate and starts feeling like a choice. Mental Model 1. Risk of regret versus risk of delay. Lump sum tends to increase the risk of regret because it concentrates your decision into one moment. If the market falls soon after, you feel the pain sharply. The regret risk is high, but it reduces the risk of delay because you're done. You move the money, you're invested. It's behind you. Dollar cost averaging tends to reduce the risk of regret because it spreads the decision. A dip doesn't feel like you got it wrong, it feels like part of the plan. But it increases the risk of delay because you are intentionally waiting to be fully invested, and sometimes people stretch that waiting longer than they meant to. So the decision can be framed as, are you more likely to be damaged by regret or by delay? Not what you should do. What you are likely to actually do. Now, mental model number 2, money risk versus behavior risk. Money risk is the risk that the market moves against you after you invest. You can't remove it. You can only manage how you experience it. Behavior risk is the risk that your own reactions cause you to make decisions that break your plan, like pulling out after a drop or waiting endlessly in cash or constantly restarting. And for beginners, behavior risk is usually the bigger threat. So, one way to choose is to pick the approach that lowers behavior risk for you. If putting all the money in at once would make you panic and potentially sell at the worst time, then the mathematically optimal decision becomes irrelevant. The best decision is the one you'll actually stick to. If spreading it out would make you second-guess every month and eventually stop contributing, same problem. The best decision is the one you can automate mentally and emotionally. Now, in a moment, we'll get very concrete with scenarios. But before we do, there's one more concept to make clean. People often treat DCA like it's a special investing trick. But for most people, DCA is just what investing looks like when you invest from your paycheck. If you invest $300 every month because that's what you can afford, that is dollar cost averaging. You're not choosing a strategy to beat something. You're simply participating consistently. And that's why this topic gets confused. There are two different situations that both get called DCA. One, you naturally invest over time because you earn money over time. Two, you have a lump sum today, but you intentionally choose to spread it out. Those are different decisions. In the first situation, there is no debate. You invest as you earn. That's just normal. In the second situation, you're choosing how fast to deploy a pile of money. And most of the emotional intensity comes from the second one. So keep that split in mind. Now, let's look at what people assume versus what's actually happening, because this is where beginners get trapped. Assumption. If I lump sum and it drops, I made a bad decision. Reality. A drop right after you invest is not proof the decision was wrong. It's proof the market moves. If your timeline is long, short-term movement is noise, not verdict. Assumption. If I DCA, I'm being responsible and safe. Reality. You're reducing emotional shock, but you might also be delaying being fully invested. That can be a sensible trade, but it's still a trade. Assumption. There must be one correct answer. Reality. The correct answer is the one that balances money risk and behavior risk for your situation, your timeline, and your temperament. And in a moment, I'll show you exactly how to make that balance without overthinking it. But first, we need to make it feel real with time. Because this decision isn't experienced in a single day. It's experienced across weeks of headlines, random dips, and the quiet parts where nothing happens, and you start doubting yourself anyway. Let's do a time-based illustration. Not with promised returns, and not with precise percentages, just with simple movement, because we're trying to understand the experience, not optimize a spreadsheet. Imagine you have $12,000 sitting in cash. Maybe it's a bonus, maybe it's savings you've built, and you want to invest it for the long term. Option 1, you invest all $12,000 today. Option 2, you invest $1,000 per month for 12 months. Now picture the next 12 months in 3 different market paths. Again, not predictions, just 3 realistic patterns markets can take. Path A, the market rises early. In the first few months, prices climb. Nothing dramatic, just up and to the right. If you lump sum, you're fully along for that ride. If you DCA, you buy some at lower prices early, but you also buy later at higher prices. So you end the year having paid a higher average price than the lump sum did. This is why people say lump sum often wins. When the market rises early, being invested sooner tends to help. But notice the emotional experience. In this path, lump sum feels brilliant and DCA feels cautious. maybe even frustrating. You might think, why did I wait? I should have just done it. Now path B, the market falls early. In the first few months, prices drop. Maybe there's bad news. Maybe there's panic. It doesn't matter. Prices are down from where you started. If you lump sum, you feel immediate pain because your full money was exposed. If you DCA, you feel less pain because only part of your money was in, and you're buying lower with each monthly deposit. In this path, DCA feels emotionally smarter. It feels like you avoided a mistake. Lump sum feels like you walked into a trap. But notice the reality. In both cases, the long-term plan is still the plan. A drop early is not an unusual event in investing. It's part of the environment. The real danger is what you do next. If lump sum causes you to panic and sell, that's behavior risk becoming real. If DCA causes you to feel safe and then stop after 3 months because you got busy, that's behavior risk too, just in a quieter form. Now path C, the market chops sideways. Prices go up a bit, down a bit, and end roughly around the same place after a year. Headlines are loud. Nothing really happens. In this path, lump sum feels boring, which is good. DCA feels okay too. But here's the twist. This is the environment where overthinking thrives. Because you don't get a clear emotional reward, you just get ambiguity. And ambiguity is exactly what makes beginners change their plan. Now, the point of these paths is not to say one strategy always wins. It's to show you that the winner depends heavily on the sequence of returns, meaning what happens early versus later. And you can't control that. So what can you control? You can control how you choose to enter and how stable your behavior will be once you're in. Now let's ground this with beginner scenarios. Scenario 1. The bonus or savings pile. You're a young professional. You've been saving. You have a chunk of money that you want to invest. But you also have a memory. Maybe you invested once before and it dropped, and you swore you'd never do that again. Or you watched someone else lose money and it scared you. So now you're stuck. What people assume, if I wait, I'll avoid pain. What's actually happening? Waiting often doesn't remove pain. It just delays the decision and increases the chance you never start. The safe move becomes inertia. In this scenario, the real danger is not the market. It's paralysis. A good approach here is often not all or nothing, but commitment without drama. In a moment, I'll show you how to do that without needing to predict anything. Scenario 2. The paycheck investor. You don't have a lump sum. You just want to invest consistently, $200, $500, whatever fits your budget. What people assume, I need to decide between lump sum and DCA. What's actually happening? You're already doing DCA by nature. Your main job isn't choosing between two strategies. Your main job is setting up consistency and reducing friction so you don't stop. For this person, the debate is mostly noise. The real lever is automation, budgeting, and staying invested through normal market movement. Scenario 3. The anxious perfectionist. You have the money, you have the intention, but you feel like you need the correct entry. You keep reading, you keep watching, you keep waiting for a sign that it's safe. What people assume, I'm being careful and responsible. What's actually happening? You're trying to buy certainty in a world that doesn't sell it. The longer you wait, the more pressure builds, and the harder it becomes to act. Eventually, you either rush in emotionally or you don't invest at all. In this scenario, DCA can be incredibly useful, not because it's guaranteed to outperform, but because it breaks the psychological logjam. It turns one scary decision into a series of smaller, survivable decisions. Now let's add another, what people assume versus what's actually happening, because this is huge. People assume DCA is always the cautious choice and lump sum is always the aggressive choice. But what's actually happening is more nuanced. Sometimes lump sum is the calm choice because it ends the decision. It removes the monthly second guessing. You invest, you move on, you let time do its work. And sometimes DCA is the aggressive choice because it requires you to keep buying through uncertainty, even when the headlines are scary. You are committing to action repeatedly, not just once. So don't label them emotionally, just see them as tools. Now I want to walk you through what this looks like in real life, because many people imagine investing as one dramatic moment, but it's usually quieter. Real life walkthrough. You choose a plan, then the world happens. Week 1, you invest, you feel relief, you feel proud, you think finally I'm doing it. Week 2, the market dips, Not a crisis, just down. You feel a little tension? You check it. You tell yourself you won't check it again. Week 3. You check it again. It's up. You feel better. You think, maybe I did it right. Week 4. It's down again. You feel stupid. You imagine you should have waited. You search for reassurance. This pattern is normal. This is how the brain reacts to uncertainty. So the question becomes, which entry style makes this pattern less likely to derail you? If you lump sum and dips feel like failure, you might stop investing. Or worse, you might pull out. If you DCA and each deposit feels like stepping into danger, you might stop depositing. Both fail the real goal, sustained participation. And this is why, before I show you the decision process, there's one mistake that ruins this for most people. They choose based on what will make them feel smartest later, instead of what will make them behave best now. They imagine future bragging rights, or they imagine future regret. And they design their decision around a story, not a system. A system doesn't require you to be right. It requires you to be consistent. So here's a calmer way to think about it. Lump sum is a bet on time. DCA is a bet on your ability to keep going. Neither is perfect. Both can work. The difference is what kind of discomfort you're willing to tolerate. Lump sum discomfort is front-loaded. You feel the uncertainty immediately. DCA discomfort is spread out. You feel smaller uncertainty repeatedly. Now, in a moment, we'll turn that into a simple method you can apply without getting stuck. But before we do, one more subtle point that helps a lot of people relax. When you zoom out to a long timeline, years, not weeks, your entry point matters less than your savings rate, your consistency, and your ability to stay invested through normal downturns. That doesn't mean entry doesn't matter at all. It means it's rarely the main thing that determines whether investing works for you. The main thing is that you build a repeatable habit, and you protect that habit from your own emotions. So the best choice between lump sum and DCA is the one that protects your habit. Now let's go to the application section, because I want you to leave with a decision process you can use in the real world, not just an understanding of the debate. Here's a calm, principles-based way to decide between lump sum and dollar cost averaging, without needing predictions, without needing a perfect moment, and without turning it into a personality test. Start with one question. If I invest this money all at once, and the market drops shortly after, will I still be able to stick to my plan? Not, will I feel okay? You might not. The question is, will I still behave correctly? If the honest answer is yes, if you can tolerate that discomfort without panicking, then lump sum becomes a very clean option. It gets your money working sooner, and it removes the ongoing mental negotiations. But if the honest answer is no, if a drop would likely cause you to freeze, obsess, or pull out, then a paced approach can be smarter, not because it's guaranteed to outperform, but because it lowers behavior risk. Now the next question is equally important. If I spread it out, will I actually finish? Because some people start a DCA plan and then stop halfway when life gets busy or the novelty wears off. They don't lose money in an obvious way. They just never fully deploy the cash, and they slowly drift back into waiting. So if you choose DCA, the principle is define it, limit it, and finish it. Not, I'll invest slowly until I feel safe. That's not a plan. That's an anxiety loop. A plan sounds like, I'm investing this pile over X months. Clear, finite. Now let's turn this into a simple structure you can follow. If you have a lump sum today, there are 3 calm paths. Path 1, lump sum now. This is for you if you want simplicity, you don't want ongoing decisions, and you can emotionally tolerate normal market movement. You accept that short-term dips are possible and not meaningful on a long timeline. Path 2, structured DCA. This is for you if investing all at once feels too intense, but you still want to start now and you want to reduce the chance of freezing. You decide a time window that feels reasonable, often a few months, not forever, and you commit to it. Path 3, hybrid. This is for people who want to reduce regret without creating a long delay. You invest a meaningful portion now, and you spread the rest over a defined period. Notice what all 3 paths have in common. Action now, not someday. Because the goal isn't to eliminate all discomfort, the goal is to prevent discomfort from turning into inaction. Now here's how you keep it grounded and beginner safe. Principle 1, reduce decisions. The more decisions you have to make, the more likely you are to stall. This is why DCA works well for many people, because it turns investing into a routine, but it only works if the routine is clear and not constantly renegotiated. Principle 2. Accept that uncertainty is the fee. In investing, uncertainty is not a bug, it's the price of admission. If you demand certainty before you act, you'll stay in cash forever, because certainty doesn't arrive on schedule. Principle 3. Separate starting from optimizing. Beginners get trapped trying to optimize their entry when the real win is simply starting and staying consistent. Optimization is a later phase. Starting is the foundation. Now, let's apply the decision process to the earlier scenarios so it feels practical. Scenario 1. You got a bonus. You feel pressure because it's a lot to you. If you invest it all and it drops, you'll feel it. A calm move might be a hybrid approach. Put a portion in now so you're participating, and spread the rest out over a short, defined period so you don't have to bear the full emotional weight of one day. The point isn't the exact split. The point is, you reduce the chance of a single moment defining your confidence. Scenario 2. You invest from your paycheck. Your job is not lump sum versus DCA. Your job is consistency. Focus on removing friction. Make it automatic in your mind and your budget. The moment you treat investing like something you decide every month, you raise the chance you stop. Scenario 3. You're afraid of doing it wrong. Structured DCA can be a powerful bridge. It turns the problem from pick the perfect day into follow a calm plan for a few months. It reduces the emotional stakes and gives your brain time to adapt to the reality of markets moving. Now, one last tool that helps you stop overthinking. Ask yourself which regret would be harder for you to carry. Regret A, I invested and it dipped. Regret B, I waited and never really started. For many people, regret B is the silent one that hurts more over time, because it doesn't feel like a mistake on any single day. It feels like nothing. And then years pass. So the goal is to choose an approach that makes regret B less likely. Now, before we close, I want to make one thing explicit. Whatever you choose, it's normal to feel a little uncomfortable afterwards. That discomfort doesn't mean the choice was wrong. It means you're doing something real in an uncertain environment. The win is that you chose deliberately, you defined the plan, and you stopped renegotiating it every time the market moves. And in a moment, I'll summarize everything into one simple sentence you can remember. Because if you keep that sentence in your head, this topic never needs to become stressful again. So here's the calm conclusion. Lump sum and dollar cost averaging are not competing religions. They're two ways of entering the same long-term game. Lump sum is simpler and gets your money fully invested sooner, but it concentrates the emotional risk into one moment. Dollar cost averaging spreads the entry over time, which can reduce regret and help you stick with the plan. But it can also delay full exposure if it drifts or becomes indefinite. So the decision is not which one is best. The decision is which one makes it easiest for me to stay invested. If you can invest a lump sum and calmly tolerate the normal ups and downs without panicking, lump sum can be a clean, simple choice. If investing all at once would likely derail you emotionally, a structured DCA plan, or a hybrid, can be the smarter choice because it protects your behavior. And that's the sentence to remember. Choose the approach that lowers the chance you stop. You don't need to rush this. Understanding the system is more important than timing it. Once you choose a clear plan, the next step is simply to follow it and let time do what time does. And if you want the next step, the next video will build on this by making long-term compounding feel tangible. How wealth is quietly built not by big moments, but by steady, repeatable inputs that don't depend on perfect timing.